I think it's time that we address these tech layoffs because these things are getting worse every single week. What's up YouTube? My name is Andres Restrepo and welcome back to my YouTube channel. In today's video, we are going to be discussing what these tech layoffs mean for the real estate industry, what is happening right now here in the San Francisco Bay Area, and how you might be able to prepare for this upcoming recession in 2023. Over the past few weeks, we have been getting announcement after announcement of a new company laying off more employees. So let's pretty much go down a list so we can see which of these companies have laid off the most amount of employees. So we're over here at ABC7 News, and we can see Meta laid off 11,000 employees. Twitter cut half of its workforce, so that was 3,700 employees. Coinbase has laid off 18% of its workforce. Stripe has laid off 14% of its workforce. Robinhood has laid off 29% of its workforce. And the list just goes on and on. So these are certainly troubling times, and it is to be expected that we are actually going through this given all of the craziness that we had happen in the past couple of years in the financial markets with COVID, the pandemic, stimulus, and all that sort of fake money and fake success that made its way into the economy. What we were seeing is pretty much companies just growing and not being profitable. So now that the Fed has reversed course and they are tightening interest rates and there is not as much liquidity in the marketplace, it's almost to be expected that this was going to happen. I empathize for all the folks out there that have recently been laid off. I can't imagine how that must feel. I'm sure it sucks. It's not the end of the world though, and I'm sure there's gonna be more opportunities as the uncertainty starts to kind of level off. And I honestly don't think that that's gonna happen anytime soon. It might be a year before we really see economic conditions to start to improve, because we know that these layoffs just started. We know that real estate here in the Bay Area is heavily dependent on tech employees, finance employees, biotech employees, because these are the folks that are making these really high incomes that are able to afford these high property values. Now, with so many folks out there having to deal with the uncertainty of not having work, I actually had a client who found me on YouTube. We were working together and his circumstances changed. He, pretty much had to switch careers. He's been looking for a job and it's been a little bit challenging. So it's very unfortunate, but that's actually what a lot of folks are starting to go through right now. We know that the real estate market here has been on the decline, and that is not news. That's pretty much been happening since about the summer of this year. From the peak of the second quarter of 2022 to the trough, we could call it so far, of the third quarter of 2022, the market for single family homes is down around 18% just this year alone. Now, if we look at year over year numbers, they're not gonna be quite as dramatic. Year over year, the market is down around 7 to 8%. The highest reading that we had, I believe, was in September of 2022, and that was around 9% down year over year for single family homes. So we know that the market is certainly getting impacted right now. Now, though inventory is not crazy high at the moment, we are seeing a lot less buyer demand in the marketplace because of all of the uncertainty, lower stock market, lower NASDAQ, and this is impacting people's ability to buy, not to mention interest rates that have nearly doubled this year alone. I would say that we are actually in a recession right now, though the news will tell you that the recession is actually going to happen next year. We know that real estate sales are down around 30% year over year here in the Bay Area, and the luxury market is down nearly 50% year over year. So a lot of people just do not have buying on their mind right now because of everything that's going on. Now, we have had positive news in the marketplace, one being that inflation has started to show signs of it peaking and potentially starting to pull back. Our latest inflation reading came out at 7.7%. Now, that's not something to rave about. That's actually still very high and far from the Fed's target of 2% inflation. So this means that interest rates aren't just rising, but they'll probably have to stay high for a considerable period of time before the Fed is actually able to reverse course. When that might be, who knows? But a lot of people are estimating that maybe the third or fourth quarter of 2023 is when the Fed might reverse course. Now, this might be a positive sign for people out there that are thinking about buying when the rates start to pull back, But when that happens, trust me, you're not gonna be the only person in the marketplace that's going to want to buy. So in my opinion, uncertain times create a lot of opportunity because A, if you're in a position where you're not laid off and you're in a company that has strong financials, which a lot of folks here in the Bay Area are still on that ship, then by all means, if you have a long-term outlook and you're thinking about staying here in San Francisco and making this your permanent home for the next 5, 7, 10 years, it certainly makes sense to buy. Less competition, more motivated sellers in the marketplace means that you'll be able to negotiate and get a better deal. Now everybody's saying, oh, interest rates are super high. Yes, interest rates have risen substantially, but there are times when they pull back and there are ways that you're able to actually negotiate a lower interest rate with your lender by requesting seller credits. I know the 2-1 buy down is something that a lot of folks have been bringing up. I'll make a separate video kind of explaining what that is. But in my opinion, you should not be buying real estate if you're pretty much looking at the teaser rate for the next 2 years. I think it makes a lot more sense if you're able to get a 7-year adjustable rate mortgage or a traditional 30-year fixed and you can comfortably afford it. That's a sign that you're in good shape and you can actually afford to buy. Recessions are temporary periods of economic contraction. There has been a lot of uncertainty. There has been a lot of pullback in many industries right now. The layoffs are also affecting title companies. They're also affecting real estate agents that maybe, weren't too financially savvy or didn't save enough money for a rainy day. And this takes me to my next point, which is how to prepare for a recession. So let's assume we're in a recession right now, but it's gonna get worse, which that's pretty much how things are looking like they're shaping out to be. So what I would do, what I personally do and have done, is keep a lot of cash on the sidelines. If you normally think about keeping a 6-month emergency fund, keep a 12-month emergency fund. Keep a 24-month emergency fund if it helps you sleep better at night. But you definitely want to be in a comfortable financial situation that will allow you to weather any storm. Point number 2 would be cut back on needless spending. If you have subscriptions or you have services that you don't really use, then cut them out. Pretty much run a tight ship right now and don't over leverage yourself. This is also a really great time to invest in your education and your skills. The more prepared you are for what's coming or the more knowledge you have, the higher the skills that you have, the more value you'll have in the marketplace. So now is a really good time to sharpen up your skills. If you have the funds to do so, invest in yourself, buy books, buy courses, do things that'll help you become a better human being and also a better business person or a better employee if that's what you do. Like I said, I do think these layoffs are just getting started, which is bad news for a lot of folks, and that will probably put some downward negative pressure on the housing market going into 2023. How much of a dip are we going to see? I don't think anybody can accurately tell you. Everything that we're hearing right now is just pure speculation. So if you're getting fear-mongered into thinking that we're gonna go into a crash, which nobody really knows if that's gonna happen or not, then it's gonna hold you back from making decisions that might potentially make sense. I can't tell you how many people I know from 2018 that didn't buy then because they thought the market was overvalued and the market just kept going up for 4 more years. Even if the market were to pull back by 20 or 30%, that would really only put us at like 2019 prices. So you need to consider that what we're seeing right now could be a very unique opportunity if you've been thinking about buying and you're in the position to do so. Now, if you are thinking about buying or selling anywhere here in the Bay Area, make sure to drop me a DM. My contact info is below. I would love to hear from you. If you guys enjoy these types of kind of like analysis breakdown videos of what I'm seeing here, boots on the ground in the San Francisco Bay Area, let me know. I will keep the property tour videos coming because I know you guys really enjoy those. But if you've watched until the end, I really appreciate your time and I'll see you in the next one.